I previously called out that I liked Sofi stock, SOFI, and when they reported third quarter results earlier today, I continue to be impressed, talking about 35% membership growth across their platform, talking about record revenue, record EBITDA, record net income. I like charts that are like this, up and to the right. This suggests you're winning. The profitability also suggests that they're reaching a new scale and efficiency that could deliver meaningful profits in the years to come. You're also seeing a critical diversification in this business, going from predominantly a lending business to a higher margin, high return on income type of business tied to financial services and their tech platform. And you can see how that is the light blue here, and it's growing to become a meaningful share of their business. You could also see how their loan vintages, their recent loans, have been performing very well from a credit loss perspective. So the non-performing loans continue to perform well relative to, let's say, a prior vintage of 2017. So suggesting their underwriting standards are doing well. You can also see their third quarter results exceeded their expectations. They provide a guidance range, 625 to 645, and adjusted net revenue, deliver 689. Talking about earnings per share of around 4 cents, deliver 5 cents. GAAP net income of 40 to 45, deliver 61. That is the type of management that I like to see. And it's a management team that just continues to say, hey, we're going to deliver this. It's an attractive return. And then they do even better. And you can see their original guidance, then their prior guidance, and then now their new guidance for 2024. Each case raising it by a bit. And it's arguably quite a compelling outlook. 22 to 23% growth this year, getting to 11 cents to 12 cents in earnings, which is up from, closer to high single digits, in the last, 2 times that they provided the earnings guidance. So talking about just an overall business that's doing well and heading in the right direction. And so it's interesting. You have a business where, you could see track record of beating expectations, beating either analysts' expectations on revenue, analysts' expectations on earnings, and yet the stock is down today, down a couple percent, depends on the volatility. At one point it's down closer to 10%. Now it's, lower single digits. Why is this happening? One case is it's potential profit taking by shorter term oriented investors, where in just the last few months, SoFi stock is up around 50%. So maybe you have a few folks saying, hey, I got to lock in these profits based on these solid results. That's one theory. Another theory is valuation. That's one argument I've heard, such as, if they're guiding to around 11, 12 cents in earnings, you have some people say, oh my goodness, Daniel, that's a crazy valuation. You're talking about $10 per share, $10, $11 stock price, 12 cents in earnings. Oh my goodness, it's like 80 times earnings. What are you talking about? Like, why did you say in your your prior video that you thought this was, that you liked it? This valuation doesn't make any sense. And also, by the way, if you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. You're watching Unrivaled Investing. And so this valuation argument, I'd say, is really misplaced, because their 2024 outlook is really still based on a low margin, low return on equity framework. And they're clearly inflecting into a new realm paradigm in terms of where their profitability will be long term. I ask AI Ticker Chat, now chat is completely free to use, about how the long-term EPS outlook could look. How do they get there in terms of their profitability? And, it goes through the last few transcripts and noted how management previously called out 2026 earnings of potentially 55 cents to 80 cents. So that's a huge jump from their outlook in this year of around 10 to 12 cents. And then they're talking about getting to margins of around 20% GAAP net income margins. So that's, more than double where they currently are, in terms of single digit net income margins. And so this is about getting to efficiency, getting to scale, and arguably, if you're talking about, let's say, closer to $1 in earnings per share, you're looking at a much more compelling valuation than the initial headlines would lead you to believe, or at least the optic figure that some people look at, saying, oh, 80 times earnings, time to lock in the profits. And this is reinforced with, Anthony Noto, the CEO, talking about, the ability to achieve higher ROE and the favorable outlook in 2025, where you have a declining interest rate environment and a stable economy, saying, look, we think we can only improve on these returns. So seeing that sort of commentary does make you think, wait a second, management's optimistic about this, seeing a lot of upside, direct quote, and yet the stock's down. So what's sort of the disconnect between what management's saying and the market? And I think it comes to the reality that the perception of 2025 being a lower interest rate period may not come to fruition. And, as a loan provider, it's important to understand this aspect of SoFi. There's a lot of moving pieces with interest rates, but when you have someone that underwrites loans, and they're predominantly personal loans, they also have student loans and mortgage loans, but predominantly personal loans. You provide, let's say, a loan. You either keep it on your balance sheet or you sell it off. They keep a lot on their balance sheet, billions of dollars on their balance sheet. And personal loans, you're talking about, like teens type of interest rate. And if you have, let's say, U.S. Treasuries move higher by a couple percent because the perception is you have a new president that maybe doesn't respect deficit spending, or maybe the deficits go out of control. Maybe you have an uptick in inflation. So you've seen a very, this is unusual relative to past economic cycles where the Federal Reserve cut rates. Jerome Powell cut rates by 0.5%. That's when I circled it here. And now it's up about 0.5% since then. This is the 10-year U.S. Treasury. So this is higher rates, not lower rates. And so there is a very real risk that we could be heading for a period where the economy's, sort of so hot that maybe you have inflation start to move to the higher, not sort of settle in at a 2% rate, maybe start to bounce higher. So that is a risk that some investors, prominent investors, have called it out. I actually, mentioned a couple of, billionaire traders that have been calling it out as a key risk in my last few letters to my subscribers. I have a weekly letter at Unrivaled Investing. And so, this is a risk that might be playing into what's going on with SoFi today, why it's down a little bit. So what are my thoughts on SoFi, the business, the valuation? First of all, in full disclosure, this is not financial advice. And also, recently, Eric wrote, and this is a direct quote, "I already have an annual subscription. I just recently paid for the premium tier subscription as I wanted to upgrade due to your great content. So if you're looking for compelling investment ideas, actionable insights, and educational content, come check out unrivaledinvesting.com. Prices will be going higher in November, so now's the time to lock in the favorable rates." So first of all, when I think about SoFi, I love a management team that consistently outperforms, delivering more than they promise. So when you see 2024 outlook and there's a prior guidance and then the original guidance, and it's just like beat, beat, beat. That is what I like to see. One of my key checklist items is alignment with management. So when I see management building credibility, where they deliver, they say, here's what we're going to do, and they do better than that. That's the type of team that I want to partner with for the long term. So that's one of the reasons why I keep going back to SoFi. I like to see that. I also like to see that they keep winning, that they're growing faster than the market, they're delivering products that consumers like. So that's important to see. They're growing faster than the bigger players out there. So they're taking market share. I also like to see the alignment where previously, this is when I did my prior videos, Anthony Noto was buying shares. So was the CFO. They're buying stock around $6, $7 per share. So they clearly thought it was undervalued. Another example of alignment, critical for my personal investment journey. That said, it is important to recognize what type of business this is. This is still predominantly a lending business. The vast majority of their contribution profit, which is one of their metrics for profitability, comes from their loan book. This is a slower growth part of their business versus their financial services, which I'll talk about in a second. But this is predominantly a loan business still. That's going to change, I suspect. It's still predominantly a personal loans business. You can see $17 billion in terms of fair value on their balance sheet of personal loans versus a total loan book of around $25 billion. So you can see home loans, tiny compared to personal loans. Student loans, that's the next largest, around $7-8 billion. That did see a nice uptick, partly because they benefited from lower rates during the quarter. There has been this uptick since then. So you had students looking to refi, and That's the reason why you had this growth. But personal loans, this is something that could come under pressure with a higher interest rate environment. That is important to reflect on. It's also more of a riskier loan asset. It is also important to call out their financial services segment is on fire. I mean, look at this contribution profit. It's gone from, negligible to 100 million in the quarter. This is, when you see a chart like this, this might mean, okay, there's something here that's not yet priced in the market, in my opinion, going from a couple million to 100 million per quarter. And that's driven by, broadly their financial services products, their money, which is their checking and savings accounts. So that's sort of a spread business similar to their lending business. But you could see other products like Relay, which I believe is an overview, which helps you track multiple different investment accounts. You could see that they're winning across a lot of these different products. And so financial services, 100% plus growth, incredible margins. This is the potential. This is, in my opinion, the future for SoFi in terms of where it can be in terms of driving much higher profitability. I consider myself a professional investor, an educator, and, I still keep my accounts at Interactive Brokers, partly because their low-cost fee structure, their high amount of cash yield that you can get, currently 4.3% plus. Their low margin rates, lower than the rest of the industry. So I personally stick with Interactive Brokers, but I do understand, and see the link below if you're interested, for Interactive Brokers. But I do think SoFi is winning from a consumer perspective. So not necessarily targeting the professional investors, but targeting the main street, the everyday consumers, the students that say, hey, I'm just looking for a bank that I can trust, a bank that will provide the solutions that I want, and it's a modern bank, unlike, many of the big banks. So when I think about a hypothetical valuation framework, this is a little bit different than I traditionally show, because this is a bank. It's important to reflect on, banking metrics versus, let's say looking at a business where it's thinking about directly, how many widgets are you selling? So around $10, $11 per share, you're talking about $11-12 billion market cap versus a book value, the equity value of the bank, the book equity of around $6 billion. So you're saying a price to book value, it's not dirt cheap, price to book value of 1.9 to 2 times, let's say. But really, this is the part that investors need to focus on, is what do you think the return on equity can be? So based on the equity that's in this business, what do you think can be the return that you get out of the dollars that are invested in this business? And I put a framework here. Honestly, this might even be on the conservative side. There's a potential this could be even higher long term, especially as they look at different products and think about having a modern tech stack. So I'm saying 15 to 25% return on equity potential. Maybe it's higher. Based on that framework, so you say 15 to 25% return on equity, you multiply those figures by the book value. And so that gives you their implied earnings potential. So you can see the potential price to earnings is somewhere between high single digits, even mid single digits, to low teens. So I personally view this as an example of, SoFi, even after the run up, I don't view it as terribly expensive. I view this as, possibly quite reasonably valued if you believe they can get to, let's say, 15 to 25% return on equity over time. Would not surprise me at all if SoFi stock, with continued execution, like we've seen so far from management, if SoFi ends up being a $20 stock within the next couple of years. Would not surprise me at all based on this execution, based on this alignment. That said, it's not easy. You're talking about a business that's transitioning from predominantly personal loans, and they pulled, and before that it was predominantly student loans. So they've shown a history of adapting to the market and the environment. You have COVID, then you have the student loan, limitations provided by the federal government. Okay, so then let's change gears. Let's get into personal loans. Okay, there's now a much higher interest rate environment. How are we going to play that? Are we going to slow down personal loans and grow our financial services? So I like to see the adaptability. I like to see management, with skin in the game, delivering. And so broadly, there's a lot that I like here. I personally, my reservation that I've expressed in the past is, and I'd say it still lingers in my mind, is the reality that the downside that you saw during COVID was a very bizarre sort of environment with, trillions of dollars in stimulus by the government to sort of offset it. And you had, interest rates, Federal Reserve put money effectively at zero. And so all of a sudden the spreads on their loan book gets very favorable. We haven't really gone through a traditional downturn. And so I'd like to see, hey, how does their personal loan book do in that environment? Now, so far management's saying, look, our credit quality is much better than even some of our past vintages that have done quite well. So overall, there's a lot to like here. And so I haven't personally pulled the trigger on Sofi. There's a lot of different companies, that are out there, a lot of, companies that fit different journeys, but I need to think more about it. I did buy a stock earlier today that is growing, closer to like 80% per year. So a lot faster, does have, the insider alignment, and maybe trades, closer to 30 times earnings. So it is more expensive, but you also have, I'd argue a better growth potential as well. So look, there's trade-offs. Every investor has a different journey. If you enjoyed this video calling out Sofi, S-O-F-I, going through the details of the third quarter results, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.